If I had to restart my investing journey from zero, I would do almost everything differently. Because the mistakes I did cost me thousands of dollars and years of my life. And the worst part is, I didn't make the mistakes because I was stupid. I hold a master's degree in business engineering. Actually, I have to admit that I made the mistakes because I thought I'm smarter than the market. Today I'm going to share with you what took me a lot of time to learn. So in this video, I will share with you the fundamentals of investing. These include, besides strategies, also shifts in your mindset. If you are able to stick until the end of this video and truly understand the concepts, what I'm trying to explain over here, then your investment journey can start today. In preparation for this video, I spent a lot of time just for the structure of this video. First, we will start talking about the mindset that's necessary when it comes to investing. Next, we will talk about active investing in the stock market. We will divide active investing into value investing and growth investing. Then I will follow up by explaining passive investing strategies such as ETFs. And one of these financial concepts can completely change your financial success. So first things first, to get it out of the way, investing requires a long-term mindset. As I promised many times on this channel, I will not talk about any shortcuts, hacks, or recommend to invest in some shady coin. If you really want to become successful with your finances, take the 10 to 15 minutes or however long this video might get, just to lay the foundation right, because on this channel we will follow up with more in-depth videos. Let me show you something. The calculator you can see at the moment underlines why having a long-term mindset is so important. Let's assume you decide to invest $500 in the MSCI World. Over 30 years with an annual return of 10%. That alone will result in $1.1 million. So you just invest $500 a month, which after 30 years means an investment amount of $180,000, and your investment increases in value by $945,700. And of course, investing is not risk-free. And even ETFs, which are widely considered as somewhat safe, have shown that they can make also big-time losses over the years. For example, if you look at the years 1990, 2002 and 2008, you'll see that the MSCI World has fallen more than 30%. Basically, what you need is longevity and resilience. These two traits are very important when it comes to investing. A timeless classic for strategical investment is called The Intelligent Investor by Benjamin Graham. Besides having a long-term vision in investing, this book also covers the strategies behind value investing. For a beginner, it's important to differentiate between value and growth stocks. Growth stocks are those companies which are considered as being able to outperform the market. Investors in these companies don't look at the intrinsic value of a stock, they are looking what the stock can become in the future, so they are investing in the future potential. Value stocks are classified as companies which are traded below their current value. Examples for growth stocks are Google, Meta, Tesla, or Amazon. Examples for value stocks are ExxonMobil, JP Morgan Chase, General Motors, or Volkswagen. This brings me to the next thing I want to talk about in this financial video. It's the concept of value investing. Value investing involves picking stocks that seem to be trading less than their book value. What value investors usually assume is that markets overreact to good and bad news. This can lead to stock price movements that don't correspond with a company's long-term financials. So if you're able to keep cool and get rid of all the noise, then you basically have the opportunity to buy stocks for discounted price. Think of it like a TV on sale. We can all agree that buying a TV for the full price or stumble on it in a flash sale offer makes a huge difference in price, right? But we can agree on that it's the same TV. The same materials are used, basically it has the same technology. That's a similar example for value stocks. The only difference is no one actually actively puts stocks in sale. Let's dive a little bit deeper into value investing so you can understand how to find value stocks. Starting with the first metric, price to book. This measures the value of all of a company's assets and compares it to its stock price. Let's do a quick example. Let's assume that the company has $100 million in assets on its balance sheet. They have no intangibles and $75 million in liabilities. Therefore, the book value of that company would be $25 million. So $100 million in assets minus $75 million in liabilities. The next thing you have to do is to look at the shares which are outstanding. Let's say there are around 10 million shares. We divide 25 million by 10 million and get 2.5. This is the book value of that company. Therefore, if the share price is then at $5, but your book value is below that on $2.5, the PB ratio would be 2, because 5 divided by 2.5 equals 2. This would mean that the stock is overvalued by the market if you look only at the assets. If the ratio would be below 1, it would be considered as a solid investment from a value investing perspective. Remember this, and I will repeat it a lot in this video. These metrics are usually really good for value stocks, not so much with growth stocks. Let's come to the next metric, the price to earnings ratio. This compares the company's share price to its earnings per share. A low PE ratio in a company compared to its peers may show that the business is undervalued. Let's clarify this with an example by looking at FedEx. We can calculate the PE ratio on the date which this video is shot at, it's February 13th, when the company's stock price closed at $374.72. The company's earnings per share for the trailing 12 months was at $18.06. Therefore, for FedEx, its PE ratio is $374.72 divided by $18.02 equals $20.79. So to be quite honest with you here and share some of my own investments, as of August last year, I was long on FedEx. The PE ratio was 13.57 back then. I always love to compare the PE ratio of an individual stock I selected to the S&P 500. In the graphic over here you can see that the PE ratio of the S&P 500 for the last 5 years was between 25 and 30. Generally you can say a PE ratio below 15 can indicate their undervaluation, and the PE ratio over 25 is often considered as high. But be aware with these metrics, a low PE ratio can also indicate that not much growth is expected for these companies. And a high PE share could also indicate that investors are willing to overpay at the moment for the future potential of the stock. And especially tech companies, which are considered as growth stocks, which I explained at the beginning of this video, have usually high PE ratios because of their growth potential. This brings us to the third metric, free cash flow. This is the cash from a company's revenue or operations after the cost for all expenditures have been subtracted. Let's compare the free cash flow to some growth companies. In our FedEx example, we can see that there was in 2025 a free cash flow of $4.35 billion. If we look at Apple, we see 110 billion. Microsoft has 60 billion, Amazon 15 billion, and Google 40 billion. So the free cash flow for those companies are much higher, right? Yes, but only if you look at the total value. Let's now add another dimension, the market capitalization. You can see that FedEx has a market capitalization of $60 to $70 billion. Apple has 4 trillion. Microsoft has 3.7 trillion. Amazon has 2.5 trillion and Alphabet, so Google, has 3.8 trillion. If you now take a look at the yields, you'll see a huge difference. FedEx have a free cash flow yield of between 8 to 10%. Apple stands at only 2.7, Microsoft at only 1.6, Amazon at 0.6, and Alphabet with only 1%. So from a yield perspective, FedEx now looks much more attractive, right? So they are generating more cash in relation to their price. And that's exactly what value investors look for. The reason why FCF yield is so low with these growth companies is because these type of companies invest their free cash back into their business. Because as the name growth stocks says it, they're trying to grow their business. In contrast to that, value companies hold more liquid cash. And one of the biggest reasons for that is the dividends that they give to their shareholders to look much more attractive. If you don't know what dividends are, well, in short, it's a distribution of profit to a company's shareholders. So let's say last year you owned a share of Coca-Cola. You would have gotten 51 cents in their last distribution cycle. Dividends can be paid out monthly, quarterly, half annually, or annually. So if you're a dividend investor, you can make passive income. And to be quite frank with you here, the stock market is the only type of investment that has shown to be truly passive. And maybe you've even heard about people that were able to live off of dividends. Let's do a quick calculation for fun to see how much money you actually need to make $3,000 a month with dividends. So $3,000 a month means $36,000 a year. Let's assume an average dividend yield of 4%. Now we divide $36,000 by 4%, we'll get $900,000. This is the exact amount we need to live off from dividends, $3,000 a month. If you don't have $900,000 just laying around, I guess it's your fault. Well, I'm just joking. I don't have these $9,000 either. We are in the same boat. I'm trying to make it as well. If you are interested in a video where we analyze together value companies and spot some good opportunities together, let me know in the comment section down below. On the other hand, to value investing, we have growth investments. This is probably the most common approach which people follow without even knowing. They hear something about Tesla in the news, or Amazon, or Alphabet, Microsoft, and they think, I can make a gain off that, let me invest in it. So they are betting on a stock's growth, not on the intrinsic value of a stock. Of course, there is a huge difference between people who are emotionally triggered by news and people who really can foresee, or better said, estimate the future potential of a stock. But one of the biggest misconceptions about growth stocks is to think that they are only in tech. That's not true. You can find growth stocks almost in every sector. Growth investing, as I said, targets companies which are expected to outperform their peers and even the market. This results in higher potential returns, but also higher risks. Successful growth investors evaluate historical and projected revenue. They are looking in detail on profit earnings, return on equity and stock performance. But compared to value investing, there is not a mathematical approach for growth investors. And still a lot of investors have come up with massive success in the growth field. One famous investor is called Philip Fisher. He tried to break down his investment style in a book in 1958. He named it Common Stocks and Uncommon Profits, and I have to recommend it to you. I know some of you may say, oh, that's almost a decade old, but the concept remains the same. But my absolute recommendation is for those who are just starting out and who don't have the money to gamble. I would definitely recommend the value investing approach from the start. That way you understand how to actively invest your money. Of course, value investing is not risk-free because you have only some mathematical methods or so. But you'll learn the fundamentals of investing. And especially you'll learn the soft skills that are required, as I said, staying patient, keeping calm, developing a plan, analyzing different companies, and then consciously making a decision. Many people lose through event and behavioral triggers, which lead to emotional investments. That's dangerous. If you find yourself stuck with emotional triggers, then maybe passive investing is something you should follow, such as investing in ETFs. ETFs stand for Exchange Traded Fund. They are quite new compared to the overall stock market. Just to compare, the New York Stock Market Exchange was first established in 1792. Compared to that, the exchange-traded funds are just babies which were found in 1993. To understand what ETFs are, we have to first look at mutual funds. A mutual fund is a vehicle in which shareholders put in their money to invest together in some securities, for example stocks, bonds and so on. A fund manager who is responsible to grow the fund makes then investment decisions. And every investor in that pool shares then the profit. One of the main reasons why people choose funds is because they are actively managed. These are professionals who have studied the game. Of course, there are also agreed fees and rates which the fund manager will get. So the main characteristics of a mutual fund is we have an active fund manager who decides on investment type decisions. On the other hand, now we have ETFs, exchange traded funds. One of the biggest pros for ETFs is that you have far less costs than an active managed fund. Plus, the fund manager of a passive ETF isn't making allocation decisions. If you, for example, invest in an index, the goal of the ETF is to track the behavior of that index. This can be, for example, the S&P 500. If you invest in ETFs, you have somewhat like a chance to get dividends as well. So if a dividend is distributed, some ETFs reinvest it directly into the net value of the ETF itself, which increases the worth. This enables you to benefit more from compounding over time. This type of ETF is called accumulating ETFs. And then there are distributing ETFs. As it already says, it distributes the dividends amongst the shareholders. But to be quite honest with you, if you decide to go for a passive approach and invest in ETFs, then you should stick to the accumulating ETFs. Because the more you invest in ETF, you will profit from compounding over time. And now maybe you ask yourself, hey, we talked about actively managed funds right in the beginning, and we have now passive ETFs. Would I get more if a professional is managing the fund? Morningstar data have shown that actively managed funds have struggled to beat ETFs, especially over a long time frame and when fees were charged. So my absolute recommendation for beginners is to start with a passive ETF strategy. I would apply the 70-30 rule, so 70% you put into a world ETF like the MSCI World, and then you put 30% into emerging markets ETF like the MSCI Emerging Markets. That way, with only 2 assets, you have a great diversification. And next I want to talk about precious metals more in detail. As in one of my last videos, I called out the gold and silver dip. I got some hate on the video, but if you would have listened and just shorted gold and silver for a short period of time, then you would have made massive gains. You can watch that video over here and check out some of those comments by yourself. There you can exactly see people getting emotional with their investments because they have money in silver and gold, and if now someone like me comes around the corner and tells them, I think the price is too high, it will drop, then they get emotionally triggered. Given what you've learned in this video, staying calm, having a plan and executing it is the right approach. At the end of the day, it's all about you being happy with the decisions you've done. If you are interested in a gold and silver follow-up, just write down below precious metals. So to sum everything up, investing is not about getting rich fast, especially when you first start out. It's about becoming the person who deserves wealth. Someone who stays calm, someone who understands, someone who asks questions and stays curious. Someone who thinks long term, but this doesn't mean that you can't short a stock or precious metals for a short amount of time. If you enjoyed the video, like and subscribe, and see you in the next one. Bye!